Hi, I'm Bill Bronchick, and in this video we'll explore 7 ways that you can finance a property without having to go to a bank and beg for a loan. Not a lot of people like to do that, so let's get right into it. The first way is the obvious one, which is to pay cash. Now, not everybody has cash, at least enough to buy a whole house with all cash, so there's some other cash substitutes we can use. For example, if you've got a line of credit, such as a home equity line of credit. If you don't, you probably should consider getting one as a second, or maybe even if you're free and clear, as a first on your home. And this is temporary financing. You can borrow against it, buy a property, and then fix it up and flip it, or maybe refinance it later. But in terms of acquisition, having cash to buy a property will always yield you a better deal because you're a cash buyer. So it doesn't have to be cash. It could be a line of credit, a HELOC. If it's a cheap enough property, you can buy it on a credit card. Use those checks that came up with your credit card bill and buy a property that way. Even though it's 18% interest, if it's a short period of time, you're not paying points as you normally would to a hard money lender. And that's another place you can go is hard money. Those are private lenders who lend based on equity, not based on credit. They go about 65–70% of the value of the property, and it's short-term money. You're going to pay a lot of money for the cost of borrowing that, usually 3, 4, 5 points up front. 3, 4, 5% of the loan is origination fee up front, plus anywhere from 12 to 18% annual interest. Again, very expensive, but if it's in the short term, could be worthwhile to do, and they can close a lot quicker than an institutional type bank. Also, you can consider number 2, which is a retirement account. And this is also buying cash, but you're not borrowing the money out of your retirement account. What you're doing is having the retirement account, IRA or 401k, that's self-directed, use its cash to buy the property in its name, so you're not borrowing from the account. Now, in a 401k, you can borrow from it up to $50,000, but if you had $200,000 or $300,000 in your 401k or IRA, the IRA or 401k itself as an entity could buy the property cash. Number 3, get the seller to carry it. So if the seller owns the property free and clear or pretty close to it, you give them a down payment, a note, and a mortgage or deed of trust secured against the property as collateral for the property. And in my other videos, we talked about some ways to negotiate the owner financing deal with a seller to obviously put as little down as possible on the deal, not having to put a big chunk down. Number 4, a lease with option to buy. Now, this isn't really a purchase. This is just a control of the property, meaning you lease the property. You have the right to possession. You're not going to live in it, but you can sublet it to a tenant and then collect the difference on the rent price you're collecting and then the rent payment you're making on the master lease to the owner. Have an option to buy in the meantime, and then you could later on sell that option to the tenant or to someone else, or exercise the option from the owner and sell it to the tenant in a back-to-back escrow. So not really an acquisition until you exercise the option, but a great way to effectively get around without financing. A partner is number 5. So OPM. You can buy cash using a partner's cash, IRA, or line of credit, or even the partner's credit to go to the bank to get the loan, so you don't have to go to the bank and beg for a loan. Let your partner go ahead and do that and then split the profits. Number 6, a contract for deed, also known as an installment land contract. And this is a scenario where the seller may already own the property with a mortgage on it, and instead of transferring title, you sign what's called a contract or agreement for deed, where you make payments to the seller, and then the seller continues to make payments on his underlying loan. When you're ready to sell the property, you pay off that seller, and then he pays off his loan and deeds the property to you, and then you can deed it to the end buyer. But you effectively, this is different than a lease option. Similar in practice because you're making a payment and then the owner's making a payment, but for all intents and purposes, you are the, quote, owner, even though title still remains in the seller's name until the property is transferred. A little confusing that way, but for all intents and purposes, particularly to the IRS, it's a sale, even though title isn't transferred until later. And then the last way is what we call buying subject to the existing loan. Just get the seller to deed you over the property and take the property ownership subject to the existing loan and just make payments on the seller's existing loan. Now, the loan probably has, the mortgage more correctly, has what's called an acceleration or due on sale clause, which allows the lender to accelerate the loan if it's not paid off or you don't assume that loan. Rarely do banks object to that in today's market, but at the very least for a short-term strategy, instead of paying off the seller and then borrowing hard money or using a partner and giving away half your equity, what you can do is get the seller to deed you over the property, give them some cash now, make the payments, fix it up, sell it, pay off the loan in a few months. Could be a great short-term acquisition strategy. Or if you don't want to put a lot of money down, like if you buy a property, go to a bank and get a loan, you got to put 20% or more down. If you can give the seller a little bit of cash, take over the property subject to the existing loan, and then maybe a year or two down the line refinance or sell, or bring in a partner to refinance the property, that could be a valid way to do that. So just in summary, you can buy cash or with a cash substitute like a line of credit, use a retirement account to purchase it, use that cash, a seller carry, get the seller to carry back the payments with a small down payment, lease with option to control it, use a partner's cash or credit, a contract for deed, which is also known if there's an existing loan on the property as a wraparound, because you're wrapping the contract around the existing payment, and then just cash for keys subject to the existing loan. Just give the seller some cash, he deeds over the property to you, you make the payments, and then you can refinance it or sell it later, or bring in a partner to do so. I hope you've enjoyed these 7 different ways to buy a property without having to go to a bank and beg for a loan. And I hope that you really use these things, that you go out and use one of these techniques. And if you do and you are successful with it, please drop me an email. I like to hear about your successes. This is Bill Bronchick, and I hope you've enjoyed this video.